Ladies and gentlemen, Asian guy here. And if you thought the metal story was going to cool off after New Year's, you need to sit down immediately. Because in just a handful of trading days, gold and silver didn't just move, they snapped higher like a rubber band that's been stretched to its absolute breaking point for months. And here's the terrifying part. The reset alerts I've been tracking are now flashing bright red across every indicator I monitor. We're not talking about normal market moves anymore. We're witnessing the early stages of a monetary system breakdown happening in real time, and most people still aren't paying attention. While they were making resolutions and planning vacations, the financial foundations of the Western world started cracking loud enough for anyone with working eyes to see. Gold just teleported hundreds of dollars higher before most people finished their January plans. Silver ripped through resistance levels like tissue paper. And this isn't happening in some obscure corner of the market. This is happening in the two assets that have served as humanity's monetary insurance policy for over 5,000 years. But here's what makes this absolutely bone-chilling. We skipped the slow build phase and went straight to the panic buying stage. The institutional forecasts that calmly predicted $5,000 gold and $100 silver sometime later this year are now scrambling to revise their timelines because the market just said, how about right now instead? The reset alerts I've been monitoring, debt spiral indicators, Treasury market stress signals, currency confidence metrics, physical demand pressure gauges. Every single one is now flashing red simultaneously for the first time since I started tracking them. This isn't coincidence. This is convergence. Let me explain exactly what's happening behind the scenes while the mainstream media pretends this is just another commodity rally. The physical demand story has completely separated from the paper markets. We're not dealing with speculative trading anymore. We're dealing with genuine panic hoarding by people who understand that when trust in the system breaks down, only physical assets matter. Coin dealers are reporting lines out the door. Trade shows are seeing thousands of people waiting hours just to get inside. The US Mint has paused multiple silver programs because they literally cannot price products fast enough to keep up with spot price movements. Premium spreads have exploded to $8.10 per ounce over spot as the supply chain buckles under unprecedented demand. This isn't normal volatility, this is system stress. When major government mints have to hit the pause button because their pricing mechanisms can't handle market speed, that tells you the move is threatening normal operations, and stress spreads like a virus through interconnected systems. But the physical shortage is just the beginning. The real story is what's happening in the pressure points that hold the entire global financial system together. Pressure point. Number one, the debt spiral has gone critical. We're not just talking about big numbers anymore. We're watching mathematics take over from politics. The interest payments on government debt now require more borrowing, which creates more interest payments, which requires more borrowing. This isn't a policy problem you can vote away. This is a mathematical spiral that ends only one way: currency destruction. Pressure point number two, Treasury market breakdown. The foundation of the global financial system, U.S. Treasury bonds, is showing repeated signs of stress that officials can't spin away anymore. Weak auctions, lack of foreign buyers, and temporary imbalances are polite ways of saying the world's most important debt market is starting to reject American IOUs. When your collateral stops being desired collateral, the entire leverage structure collapses. Pressure point number three, commercial real estate apocalypse. This slow-motion train wreck is accelerating as refinancing happens at interest rates that turn profitable buildings into financial disasters overnight. The exposure isn't just in real estate, it's in the banks, the derivatives, the interconnected balance sheets that nobody wants to mark to market until they're forced to. And when they're forced to, that's when you get surprises that become contagion. Pressure point number four, global de-dollarization acceleration. Countries aren't just talking about alternatives to the dollar system anymore, they're implementing them. Regional trade settlements, gold-backed digital currencies, bilateral swap agreements that bypass Western financial rails entirely. Even small experiments matter because they create pathways, and adoption can accelerate exponentially during crisis moments. Pressure point number five, the control response infrastructure. Digital payment monitoring, central bank digital currencies, tighter surveillance networks disguised as financial stability measures. This infrastructure doesn't get built because everything is healthy. It gets built because the system is preparing for crisis and wants tools to manage public behavior when trust evaporates. Here's the terrifying mathematical reality. You don't need all these pressure points to explode simultaneously. You just need 2 or 3 to create cascade failures that overwhelm the system's ability to respond. And right now, we're seeing stress signals across all 5 categories at the same time. The currency confidence crisis is already here. It's just disguised as manageable inflation. When people talk about feeling gaslit by economic statistics, this is why. Official inflation numbers say everything is stable while grocery bills, insurance premiums, and basic living costs spiral out of control. The gap between official statistics and lived reality is destroying faith in institutions faster than any conspiracy theory ever could. Gold and silver aren't just rising on speculation. They're rising because people are waking up to the fact that the game is print, promise, repeat. And when enough people stop accepting promises and start demanding real assets, prices adjust to mathematical reality. But here's where it gets really dangerous for unprepared investors. We're entering the phase where physical and paper markets completely disconnect. In normal times, you can trade paper gold and silver with minimal spreads and instant liquidity. But when demand shifts to physical possession, the paper markets become irrelevant almost overnight. Think about what happened during the early COVID panic when people couldn't buy physical silver at any price, while paper silver traded normally. That disconnect is coming back, but this time it won't be temporary supply chain disruption. It will be permanent recognition that paper promises aren't the same as physical assets. The Federal Reserve drama adds another layer of accelerant to this fire. The institution that's supposed to manage monetary policy is caught in an impossible trap. Keeping rates high reveals the leverage and breaks the debt system, but cutting rates sacrifices currency purchasing power and accelerates inflation. Either choice leads to the same destination: hard asset repricing. Every new temporary facility and emergency backstop program is an admission that the previous promises weren't sufficient. Each intervention reduces confidence in the underlying system while increasing the premium on assets that exist outside that system. But here's what most people don't understand about system transitions. The reset isn't one dramatic day where everything changes. It's a process of slow decay, punctuated by sudden recognition events. We're watching it happen in slow motion with occasional bursts of speed. Exactly like what we're seeing in precious metals right now. The crowd doesn't arrive until the move is obvious to everyone. By then, physical premiums are astronomical, delivery times stretch to months, and availability disappears for everything except the most expensive options. Smart money positions before the crowd recognizes what's happening, and the crowd recognition phase is approaching faster than most people realize. When mainstream financial media starts covering precious metals, rallies with panic rather than dismissal. When politicians start proposing emergency measures to stabilize markets. When your neighbors start asking about buying gold and silver. That's when you know the public phase has begun. The technical setup couldn't be more perfect for continued acceleration. Gold has broken through decades of resistance levels with the kind of momentum that suggests institutional repositioning, not retail speculation. Silver is showing the explosive catch-up patterns that historically precede the biggest moves in precious metals history. But the fundamental setup is even more compelling than the technical picture. We have simultaneously currency debasement through money printing, debt spirals requiring more printing, supply chain stress creating physical shortages, geopolitical fragmentation reducing dollar demand, and public awakening to monetary reality. Those conditions don't resolve themselves. They compound until something breaks permanently. The international implications are staggering. As dollar dominance erodes even at the margins, those dollars don't disappear. They come home to chase a finite supply of American goods and services. That's the inflation that people feel in their daily lives, not the sanitized version that appears in government statistics. Countries that reduce dollar reserves buy gold instead. Countries that settle trade in local currencies need neutral collateral for trust. They buy gold. Central banks that want insurance against currency instability, they buy gold. And private citizens who understand what's happening, they buy gold and silver before it becomes obvious to everyone else. The window for easy positioning is closing rapidly. Physical dealers are already struggling with inventory shortages. Premium spreads are widening daily. Delivery times are extending as supply chains buckle under demand pressure. Most importantly, the psychological shift is accelerating. People are moving from thinking like traders to thinking like savers. Traders can sell in 5 seconds when prices move. Savers stack physical metal and forget about it for decades. That metal disappears from circulation, creating the scarcity that drives the next phase of price discovery. The reset alerts turning red aren't theoretical warnings anymore. They're real-time confirmations that the monetary system people have lived with their entire lives is approaching mathematical limits. When those limits are reached, assets that exist outside the system don't just rise in price. They reset to reflect their true value in a world where paper promises have lost credibility. Every day you wait to position becomes more expensive as supply disappears and recognition spreads. The smart money moved months ago. Institutional money is moving now. Public money will move when availability disappears and prices gap higher in moves that make current volatility look calm. This is Asian Guy, and the gold rush hour has begun. The reset alerts are screaming red, the pressure points are converging, and the window for preparation is measured in weeks, not months. Position accordingly while you still can.